You got Millionaire Mop here, ready to show you exactly how to use a dividend discount model Excel template, which you can find at millionairemop.com/short form dividend discount model. The dividend discount model here is a short form version of the model. There's definitely a long form where you take annual dividend growth over time, versus the short form assumes that the growth rate will happen into perpetuity. Therefore, the input itself on the growth rate is a significant driver of the fair value of the company's stock. But that being said, it's a good model to use to at least do a gut check of a company and its valuation, as well as the prospects for further dividend increases and dividend growth. So here's the template. There's three various inputs that you can go through. The first one is blue cells, which are your input to the model itself. The second is pink cells, which are external inputs to the model itself. And then the third is green text, which represents your final output value. Everything in between here is just a formula that runs off of everything that's been input in here already. So in terms of your blue cells, the biggest driver is obviously your expected annual growth rate. This is a sort of a cap rate or a perpetuity growth rate for the stock. And then the current dividend is the current dividend paid per share of stock. And then everything else, let's go through. Let's start with the external outputs. The risk-free rate is typically a 10-year treasury. The 10-year treasury has always been viewed as a risk-free rate relative to the market. And so we have 2.66%. You can just pull this from CNBC. The next is expected market return. You can easily just click this hyperlink within the dividend discount model Excel template. If you go down to US, we're currently at a 7.4% risk premium. What that represents is basically the market return relative or over the risk-free rate. And so basically the anticipated estimated market return is 7.4% relative in above the risk-free rate of 2.66%. For this particular stock, let's go through Apple. I think that would be a great example stock to use. Let's pull down their information from Yahoo Finance, which I have here on the summary level. Apple stock's beta is 0.99. I've input that here. That makes a lot of sense. Why? Because beta is a barometer of return and risk profile for the overall market. One represents the market. Apple itself is the largest holding of the market, or the S&P 500. Therefore, much of the movement derives the overall market as a whole. And so that's why it is very, very close to one overall. In addition to that, 2.92 is the dividends paid out per share. I've input that here. Let's just check to make sure that that's the right number. I think the Apple stock is at 172.03. Yep, 172.03. That represents 1.7%. Okay, perfect. We're at 1.7%. So right now at an 8.8% expected annual growth rate, that implies the stock is at 158.71. Just to show you exactly how sensitive this input is, if we go to 8.25, that brings us to a value of 181.97. If you go to 8.5, you're at $213. So let's go to, I think 8.25 is actually not unreasonable. Let's dig in just a little bit more in terms of the financials themselves. So current year EPS is at 1.4 or 11.4, I'm sorry. So 11.4 would imply the payout ratio is 25.6%. That's extremely low. There's significant runway for that to be increased over time. Um, Next year's estimate is supposed to be 12.74. So if you go 12.74 divided by 11.4 minus 1, of course. Okay, so now you have a next year. So next dividend payout ratio of 25.6%, next year EPS growth of 11.8%. Apple is very, very large. I have trouble believing that they will continue to grow EPS at 11.8%. Um, you know, I think they're capable of doing that in terms of next year. I don't know if they're able to do that uh, into perpetuity. But on the converse, I don't think it's appropriate to do sort of a 4 or 5% expected annual growth rate because the dividend payout ratio itself is extremely low, and so they could basically for the next 3 years have stagnant EPS growth, but yet still grow earnings per share at least 8% per year. So I do think that's a fair sort of estimate right now. Um, Apple, I think, is a must-have for any dividend investor. Yes, it's a low pay dividend yield, but you are rest assured if you're a young investor, you're able to see further dividend increases without a doubt into the future. Apple's one of the highest credit rated companies out there in the world right now. It's basically like a risk-free rate at this point in time, if you will. But I think that the dividend will grow at least at 8% for the foreseeable future. Um, but thereafter, it's anyone's guess in terms of earnings per share growth. For me, I prefer to have more of a weighting towards companies that have higher EPS growth but still do pay a dividend. I do like the fact that the payout ratio is around this percentage, but at the same time, I'd love to see that EPS growth even higher relative to the valuation of the company so far. So that's the short form dividend discount model Excel template in a nutshell. Let me know if you have any questions in the comments below. You can download the model at millionairemob.com/short form dividend discount model.